On March 22nd, 2021, the Securities and Exchange Board of India permitted mutual funds a glide path or a phased implementation of its earlier announced 100-year maturity rule for the valuation of perpetual bonds. This offers some relief to mutual funds. Now, all existing Basel III AT1 bonds, otherwise known as perpetual bonds, and the new ones issued until March 31st, 2022, will be deemed to have a 10-year maturity to start with. For instance, the maturity of the existing bonds will be upped to 20 years for the time period between April 1st, 2022 and September 30th, 2022. The newly issued bonds will be deemed to have the maturity depending on the time period of their issue and will then be upped in the manner mentioned in the table. Basel III Tier 2 bonds will be valued assuming a 10-year maturity or the actual maturity of the bond, whichever is earlier. What does it mean for the investor? Once these bonds are assumed to have a 10-year maturity, they become less valuable than before. As a result, the prices of such bonds will fall and their yields will rise. According to a few financial advisors, the yields on many of these bonds have already seen a rise. Mutual fund schemes that have significant investments in such bonds are therefore expected to experience a drop in their NAVs on April 1st when the new norms come into effect. This will be due to the mark-to-market loss on bonds as they get revalued based on the 10-year maturity rule. Investors ought to remember these points. Number 1. With the 100-year rule deferred to April 2023, the drop in NAVs is expected to be milder than originally anticipated, especially for schemes where the exposure is not significant. Number 2. Even for schemes where the exposure is high, if it is to bonds of leading banks such as State Bank of India, ICICI Bank, Axis Bank and HDFC Bank, there may be less cause for concern. Investors with a low risk appetite need to reconsider the investments where the scheme exposure to perpetual bonds is high, say 15% and above, and such schemes form a large portion of their debt portfolio. Click the link in the description below for more details.